You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings without the corporate fluff. I'm Susie.
And I'm Miro.
And today is January 20th, 2026. We are looking at 3M. And Miro, they've been calling 2025 a foundation year, but looking at this fourth quarter, it feels a bit like they're still pouring the concrete while the building is shaking.
Yeah, or maybe finding cracks in the concrete they just poured.
Right. Okay, so give us the damage. What are the headlines?
It's messy. Look, revenue came in at $6.13 billion, which is down almost 6% from last quarter. Adjusted EPS was $1.83 compared to $2.19 in Q3. But the real ugly number is the GAAP earnings per share, $1.07. That's a steep drop from the $1.55 we saw 3 months ago.
Oof. And the market reaction? I saw a lot of red on the screen this morning.
Yeah, it was volatile. Typical 3M lately. The stock gapped down, tried to rally, then just sold off. Closed around 156, down about 2%. Investors clearly didn't like the margin compression.
Which was significant, right? I mean, I saw the operating margin numbers and thought it was a typo.
I wish. Sigh. GAAP operating margin collapsed to 13%. For context, it was over 22% in Q3. Even the adjusted margin fell to 21.1%. When you see a sequential drop like that in an industrial giant, that's not just seasonality. That's structural friction.
Right. And before we get too deep into the friction, just a quick reminder for everyone listening, none of this is financial advice. We're just two people looking at numbers and having opinions. Please do your own research before you buy or sell anything. Okay, disclaimer over. Miro, why the huge margin drop?
2 words, litigation and solventum. See, in Q3, they actually had a litigation benefit. This quarter, back to reality. They took a $160 million pre-tax charge for the PFAS and earplug settlements.
It's the gift that keeps on taking.
Exactly. It swings the GAAP numbers wildly. You can't model it. And then you add another $160 million negative adjustment for the value of their stake in Solventum, that healthcare spinoff. So you have these massive non-operational anchors dragging down the bottom line.
It feels like 3M is 2 companies right now. There's the one making Post-its and grinding discs, and then there's this legal holding company attached to it?
That's actually a painfully accurate description. But look, even if you strip out the legal stuff, organic sales growth slowed down to 2.2%, and the consumer segment, the stuff that people actually buy at Target or Home Depot, sales were down.
That's the part I want to stick a pin in, because on the call, the CEO mentioned December was up double digits. That sounds great, but the quarter itself was negative. It feels contradictory.
It's the consumer head fake. Heavy promotions, holiday discounting. They moved volume in December, sure, but at what margin? It raises the question, is the U.S. consumer actually recovering, or is 3M just buying revenue with price cuts?
And frankly, with them talking about a mainstream electronics pivot, it sounds like they are intentionally moving down market, which is risky for a company that prides itself on premium engineering.
Extremely risky. It changes the whole economic equation.
All right, let's get into that, because the noise is loud, but the signal seems to be burying itself in the cost structure. Let's dig into the details.
Okay, so here's the thing that really jumped out at me, and I think a lot of people glazed over it because it was buried in the Q&A section of the call. Management explicitly talked about shifting their electronics strategy to go after the mainstream market.
Mainstream isn't 3M, aren't they usually the premium option? The we solve the problem nobody else can solve company?
Exactly. Historically, they play in the top tier, the 80-20 rule, high margin, specialized engineering. But the CEO, Monish, basically admitted that strategy's capping their growth in Asia. So now they want to fight for the mid-tier, the high-volume stuff. And to do that, they're rolling out this new philosophy called design to cost.
Design to cost. That sounds like a polite way of saying make it cheaper.
It is exactly saying make it cheaper. But look, it's deeper than just price cuts. It means you change how you engineer the product from day one. You don't start with, what is the best adhesive possible? You start with, this needs to cost 4 cents per unit. Figure it out.
Okay, but that feels like Almost like a spiritual shift for a company like 3M. I mean, their whole identity is innovation. The Post-it note wasn't designed to cost a penny. It was designed to be useful. If you start telling 3M scientists to act like discount manufacturers, don't you risk breaking the culture?
You absolutely do. And that's the risk here. They are trying to pivot from a value-add model to a volume model in electronics. If you get that wrong, you end up in a price war with competitors in Shenzhen who have been playing the low-cost game for 20 years. And frankly, 3M's overhead isn't built for a street fight.
It's like asking a Michelin star chef to run a burger joint. Like, sure, they can do it, but is that really the best use of the kitchen?
That's a surprisingly good analogy, and the financials back it up. We saw $55 million in transformation costs this quarter just to redesign their manufacturing footprint. They're physically closing plants and moving lines to match this new reality. They called it redesigning the network.
Redesigning the network. Short pause. Corporate speak for closing factories.
Precisely. They have about 100 plants right now. The CEO hinted pretty heavily that number is going down in 2026. So when you combine that with this design-to-cost push, the picture becomes clear. They aren't just stabilizing the company. They're fundamentally stripping down the engine while the car is moving.
Which explains why the margins are so jumpy. You can't pivot to mainstream pricing without taking a hit on profitability unless your efficiency is perfect. And clearly, looking at that 13% GAAP operating margin, it's not perfect yet.
Far from it. And remember, they're doing this while carrying that Solventum stake. We saw a $160 million write-down on that this quarter. So you have this financial volatility on the balance sheet paired with an identity crisis in the factories. It's a lot of moving parts.
It really is. It's like trying to turn an aircraft carrier like it's a jet ski.
And usually when you do that, things fall off the deck.
Right. So, okay, we've got the strategy shift, the cost cutting, and the identity crisis. Let's step back for a second and think about what this actually means for 2026. Because if this is the foundation, I want to know what they're planning to build on top of it.
Well, if the foundation is solid, the house they're planning to build on top of it is, let's just say, modest. They're guiding for organic sales growth of about 3% in 2026, adjusted EPS between $8.50 and $8.70.
3%. That's, after all the drama, the transformation, the factory closures, we're basically just tracking GDP?
Right. But at this size, 3M isn't a growth stock anymore. It's a repair story. And honestly, even that 3% isn't a layup. They explicitly flagged potential European tariffs. Could be a $30 to $40 million hit. And they admitted auto production is looking soft.
That's the tension, isn't it? They're furiously fixing the internal plumbing, but the external weather is getting worse.
Exactly. And that puts them in a corner. When you have macro headwinds, like a weak consumer or tariff risks, you have zero room for execution errors. And 3M has been, let's be polite, error-prone lately.
So it really comes down to trust. Investors are looking at this guidance and asking, is this real? Or is there another litigation charge hiding in the footnotes?
Precisely. They need a boring year. No more special items, no more volatile swings from the Solventum stake, no more surprise legal bills. To get the multiple back up, they don't need brilliance. They just need predictability.
Make 3M boring again.
I'd buy that hat. Seriously, boring is the new alpha. Just hit the singles, protect the dividend, and stop giving us heart attacks with the GAAP numbers.
So, what's the tell for next quarter? What are you watching?
Margins. Pure and simple. If this design-to-cost pivot is real, we should see margin stability even if sales are flat. If margins compress again in Q1, then the foundation isn't settling, it's sinking.
So we'll be watching to see if the glue holds.
Was that a pun?
Obviously. Come on, it was right there.
Okay, fair enough.
All right, that's the reality check for today. If you enjoyed the breakdown, or if you just want to hear Miro complain more about corporate accounting, hit subscribe. We'll catch you on the next print.
Thanks for listening.
Before you go, a quick transparent note on what you just heard. Earnings Unscripted is an experiment. We're a small team of enthusiastic people exploring the frontier of AI, trying to figure out how it can be used to enrich us, not just to automate tasks, but to tell stories that actually matter. To be totally clear, this entire episode was created by a team of AI agents, from the research analyst digging through the financial reports, to the scriptwriter crafting our dialogue, to a fact-checking QA specialist. Everyone involved in the workflow is an agent working to deliver high-quality, up-to-date information that would hardly be possible otherwise. Even the voices you're hearing right now, mine and Miro's, are generated.
Yeah, and don't worry, the skepticism is real, even if the voice isn't. See you after the call.